Hi, everyone. Today, let's talk about the markets. I know I've been gone for a little bit, and if you want to ask why, I'll definitely answer down in the comments, but otherwise, let's get straight to these technicals. During my time away, the markets have certainly been going crazy for a number of reasons, and you can see here interest rates are expected throughout the year due to the rising inflation, which continues to be quite high and is not temporary. You can see it has been quite high, hitting 7.9% in February, which is certainly very high considering that that's the highest rate since January of 1982. And of course, we have the uncertainty that is the war in Ukraine. Russia has invaded Ukraine, and who knows exactly where that's going to go and what kind of consequences the economy will face based on this tragedy. We'll start here with the Russell. Definitely seems to be one of the strongest of the group, and we'll hit the S&P 500, and we'll hit the S&P 500, which is still pretty bearish. Then we have the NASDAQ here, which is the most bearish of the group. Then we'll hit on XOP, which seems to be doing quite well, even if it's a little overextended here in the short term. If you like trading stocks and options and making money, definitely like and subscribe. I will get back to making videos like this every single week, so make sure you hit the bell so you don't miss out on any future content. Welcome to the Portfolio Bulletin. Let's get started. So just in case you've been living under a rock or in Iraq, Russia did invade Ukraine, and there is concerns that this could lead to World War III and some other major questions. They've been doing this for a little bit over 2 weeks now, and they've displaced around 2 million Ukrainians, and this is certainly a humanitarian crisis. So of course, the concern here is, how does this affect the economy? It's estimated that they've done around $120 billion worth of damages already in the Ukraine, and of course, if the US goes directly and starts attacking Russia, this would escalate into a global conflict. And that still remains to be seen. However, the U.S. is certainly posturing with around 14,000 troops in NATO countries such as Germany, Poland, and Romania, just in case Putin decides to venture outside of the Ukraine. In my opinion, this invasion is not going quite as well as they thought that it might. I think they thought Ukraine would roll over and they would be able to conquer them fairly quickly. However, it does not seem to be going that well, and there's certainly a lot of clips of Ukrainians conducting ambushes on various Russian forces with some pretty good success. This is creating a perfect storm with inflation, which is continuing to rise at 7.9% here in February, which is the highest, as I mentioned, since January of 1982. Over the past 12 months, it's gone up at 6.4%, again, a very high margin, gaining the largest since August of 1982. And they think that the Fed will continue to raise rates 3 or 4 times this year to help stem the amount of inflation that we're seeing. Of course, inflation is being elevated by the fact that supply chains are heavily disrupted due to the Rona. We're still trying to recover from that. And then we see very large increases in oil costs due to the war in Ukraine. Inflation does not seem to be transitory, and energy prices are continuing to go up, jumping 3.5% in January, while over the last 12 months they've gained 26% and gas prices are up 6.6%. Anytime energy costs go up, it does drive up the cost of everything else because it does take energy to either move it or take care of it throughout the world, and that cost gets translated to the consumer. And as I mentioned, the Fed expects to raise interest rates several times throughout this year, and some people expect inflation to continue to get higher, closer to 10%. They say Jerome Powell has hinted at raising rates pretty extensively, as he expects inflation to drop below 3% by the end of 2022. However, it is kind of concerning. 2021's inflation rate was at 7.5. Of course, this leads to rising prices as well as wages as people try to keep up with this inflation. This article is saying they may increase rates 7 different times this year, with the first expected to happen on March 16th, being a 1/4 of a point increase, and the Fed will start selling treasuries and mortgage-backed securities to start offloading its balance sheet this year. As we push up the short-term security interest rates, the long-term interest rates also tend to go up, with the expected 10-year interest rate to go up to 2.3%. So what all of this means is, as interest rates tend to go up, the market tends to go down, as they have an inverse relationship with stocks versus bonds. Moving over here to IWM, or the Russell 2000, I want to start with this one because it does look the strongest out of the group. You can see had a big bull run here in 2020, pretty sideways here through 2021. And then recently we had a down move along with the rest of the markets pretty substantially. But we're kind of in this little wedge pattern from the long-term price channel that we had previously. And I've mentioned this in several other videos. You can see we had some strong reactions with that, even touching this lower price channel here and interacting with this higher price channel. This could certainly go either way, up or down, based on this wedge or this triangle. But right now, it's still slightly bullish in terms of the support based on these lower trend lines. In the very short term, you can see we're not quite on that lower trend. Expect a retest of that potentially here in the next day or two. And you can see here on the MACD, which I'm going to start using a little bit more, you can see we're basically sideways, almost at the zero line for the moving averages, and then the momentum is basically flat. So this may be a good place to sell an iron condor if you feel comfortable. If this is a stock you want to own, you could potentially sell puts here with the low end expected to be around 194.50 or so, or at the lower trend line around 191. Moving over here to SPY, you can see we had that big long bull trend, started to lose momentum here from October up until January. Then we had that breakdown, hitting these previous levels, had a short bounce here in January to February, retesting, and now we have this downward wedge forming basically at support here, so maybe a potential for a short-term bullish move of maybe 2% to the upside, but I don't expect this resistance to break right now, as this pattern is just kind of getting started here. You can see the momentum is also slightly bearish. Definitely not as strong of a bull trade here on the SPY. Moving over here to the NASDAQ, very similar. Not as weak here at the top. You did see that kind of topping pattern here right around $403 per share. And then we broke down pretty strongly with that bearish wedge. And you can see we're still a couple of points off of support here, somewhere around 318 per share and currently at 324. So a couple of points lower until we see a potential for upside support. Definitely the most volatile of the three indices. And you can see these moving averages up here, quite a bit of space, as this has been a dramatic move down, quite a bit weaker than the other indices. And then you can see kind of neutral here on the MACD, but still in the red here, potential for an increase similar to what we saw here in January. And tech is definitely the most affected by inflation and the rising rates. So that could potentially be why the QQQs is being affected the strongest out of the group. Lastly here we have XOP, or the Oil and Gas Product Index. We've seen some pretty strong moves up, bouncing from around $91 all the way up to $130 in a short period of time. I thought this level of resistance might have a stronger effect, and we did see some retrace and some retests of that level before seeing a very strong move up. And you could argue that this was driven by fundamentals, as the oil and gas industry is certainly seeing some pretty strong effects due to the war in Ukraine, which is driving up oil prices specifically, which generally is good for oil and gas producers as they can sell things at a higher price due to the increased demand and reduced supply. Not quite at resistance here. There's upside potential up to around $150. Although I will say here in the last couple of days, it's been pretty overextended. Might see a retrace, a couple dollars lower before I expect a continuation up to that previous level of resistance that we saw here in October. So price target somewhere around $150, $155 over the next several months, but a short-term bearish retrace before continuation is my expectation. Let me know down in the comments section what you think of these effects on the markets or the various indices and their current technical patterns. Definitely comment down below if you disagree or agree with any of my opinions. And make sure you like and subscribe before you go and hit the bell so you don't miss out on any future content. Of course, none of this is financial advice. This is all for entertainment purposes, and have a great day.